Valley Bank in the United States collapsed suddenly. This failure of the California-based lender market marked the largest bank failure since the 2008 financial crisis, which was a great setback across global financial markets. How has the recent bank run affected the investors, and how is the current financial system risking more banks to run without aids? A bank run causes too many customers of a bank attempting to withdraw their money at the same time, and this can happen when a customer believes their bank is about to fail. This can cause a fear of insolvency since banks typically do not hold enough money to cover all their clients' deposits. Now what happened is that the collapse of Silicon Valley Bank and Signature Bank prompted a flood of deposits out of regional lenders and into the nation's largest banks, including J.P. Morgan Chase & Company and Bank of America Corp. Customers spooked by the bank failures were taking refuge in firms that were too big to fail, according to them. In order to avoid a wider run on the banks, a coalition of mid-size U.S. banks asked federal regulators to extend FDIC insurance to all deposits for the next 2 years. The Mid-Size Bank Coalition of America said in a letter to regulators, doing so will immediately halt the exodus of deposits from smaller banks, stabilize the banking sector, and greatly reduce chances of more bank failures. According to the group of mid-size banks, the confidence in the banking industry has eroded in all but the largest banks, and it needs to be restored as soon as possible. They added that the deposit flight would accelerate should another bank fail. The group also cited remarks by Treasury Secretary Janet Yellen that backstops put in place so far will protect uninsured deposits only if regulators found it necessary to protect the financial system. Yellen said that bank depositors can feel confident their money is safe. She promised a thorough review of what went wrong at 2 failed banks. While appearing before a Senate committee, Yellen got all kinds of questions about the bank failures. She replied that the administration is committed to protecting bank customers. After Silicon Valley Bank in California and Signature Bank in New York collapsed, both the FDIC and the Federal Reserve took extraordinary actions to make sure the people and businesses who had money in those banks would not suffer losses and to limit the kind of financial ripple effects that might have put other banks at risk. Now there has been a lot of finger-pointing going around, and the question that arose is, who or what is to blame? The blame for what happened is attributed with bank managers who made some rookie mistakes, extending to federal supervisors who apparently failed to catch and correct those mistakes, and most probably the members of Congress who watered down some of the measures designed to prevent this kind of problem after the great financial crisis. Yellen said that Silicon Valley was brought down by a classic bank run. Virginia Senator Mark Warner noted that this bank run happened with extraordinary speed. Many of Silicon Valley's bank's depositors are part of that tightly knit tech industry in the Bay Area, and the minute news of Silicon Valley Bank's trouble started to light up on their cell phones, they switched to their banking apps and tried pulling out tens of billions of dollars. According to Yellen, Silicon Valley Bank was particularly vulnerable to a classic bank run because much of its deposits were uninsured. The whole purpose of deposit insurance is to discourage bank runs by letting customers know their money's safe. However, the FDIC typically covers only $250,000 per account, and most of the money on deposit at Silicon Valley Bank was not covered. Republican Senator James Lankford asked Yellen that if a small bank in Oklahoma goes down, will its big customers get the same kind of protection? She replied, not necessarily. This is a cause for concern. Senator Elizabeth Warren favors the FDIC's standard $250,000 cap, possibly into the millions of dollars. However, she declined to say whether President Joe Biden's administration is actively seeking support to build support in Congress for raising the FDIC's ceiling. Janet Yellen said in the Senate hearing that not all insured deposits will be protected in future bank failures. Meanwhile, Congressman Blaine Luetkemeyer has warned that if the government does not guarantee all bank deposits, there's going to be a run on smaller banks. What do you think of this? Are smaller banks safe from future bank runs? Let us know your thoughts in the comments below.